Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Want to talk retail now because we've got more numbers out today from some big players, including Kohl's and Abercrombie. Let's break it all down now with Mary Ross Gilbert, Bloomberg Intelligence's senior equity analyst. She covers retail. So she's the right person to talk to right now. So, Mary, Kohl's trying to reverse 14 straight quarters of declining revenue. How'd they do?
Yeah, so Alexis, Kohl's, okay, look, they reported comp sales down still. And as you pointed out, 14 consecutive quarters of declines, or another way to look at it, over the past 3 years, they're cycling 3 years of declines. So, but what really we're looking at in the news that came out with Kohl's, one is that on the call, the company said July sales were flat. That was really encouraging. And when you look at the third quarter and the guidance for the third quarter, again, still looking for declines for the balance of the year, down 4 to 5% on a comp sales basis. But for the third quarter, they're going to cycle a 9.3% decline last year. So that means the comparisons are easier and they're off to a good start. So it's encouraging. And what we're finding is that they're bringing back the core private brands that are really resonating because they're the open price points, and their core consumer, which is that sort of low to low middle income consumer, they're really pressed by inflation still. And so they are really looking for the value. And as they've brought that back in, and they brought back fashion jewelry, and they're working on refining fine jewelry, but that's all resonating now with the customer. And so that's where they're seeing some strength. And so we're seeing encouraging signs there, but they're not out of the woods yet, right? Because, again, 3 years of comp sales declines, and their sales are still declining. So we'll see if they actually reach stabilization by the end of the year. They're saying no, we're not, but we're thinking they're providing conservative guidance so that they can beat. And then with regard to the stock action, part of that reflects short covering. If you look at the shares borrowed, it's about a third of the outstanding shares are borrowed. So it's going to take over 5 days to cover, shorts. And so that's part of the action in there.
Hey, Mary, what are Kohl's and some of the other companies saying about, their strategies for dealing with tariffs in terms of A, passing along to consumers, B, taking it maybe in their margin, or C, kind of pushing back on some of their suppliers? Is there a consensus building about how some of these retailers are dealing with it?
Yeah, Paul, that's a really good question because tariffs is absolutely top of mind. And with Kohl's really sources most of their product from other brands and companies. They do have their own private brand business. It's probably somewhere around a third of the business. They're getting it back in order because, of course, they went too low last year. And what they're finding is they're sharing with their vendors. This is what we're finding across the board, and they're finding an ability to raise prices on select items. So with Kohl's, we did see a margin improvement in the quarter, and so because the private brands do deliver a higher margin on an overall basis versus the third-party brands, they're getting that benefit, and that's helping to offset a bit of the tariffs. And again, they're less impacted versus some of the specialty apparel brands like Abercrombie and PVH and those companies reporting, which they did disclose what kind of exposure they have. But we are seeing across the board that there is sharing. It's usually about 50%, where the suppliers will say, we'll absorb 50% of the cost, and then the other 50% is taken by that brand. Then they will do strategic price increases on certain items that they feel will be less noticeable to the consumer.
Mary, before we get to Abercrombie, one more question here on Kohl's. Bloomberg News is reporting that Kohl's is having trouble paying its vendors on time. What do we know about that?
Alexis, I'm really glad you brought that up because that was never brought up on the call. Nothing came up in that conversation. When we saw that article break yesterday, we said, what? I mean, that's kind of like a warning sign. And it basically says, look, they're just trying to manage their working capital needs because we're in a period right now where they're taking in all of the inventory that for the holiday season. That's coming in right now. And so that's a big cash use. And that's kind of where we are in the third quarter, is where they're going to have to, raise their revolver borrowings to fund those needs. And so there was a bit of a concern, but nobody on the earnings call brought that up with the company. But we're watching that closely. Like I said, Kohl's is not out of the woods yet.
All right, Abercrombie, what's the story there?
So on Abercrombie, generally they beat, but okay, and it was all led by Hollister, which we could see in the transaction data, and it was something that we saw in the first quarter. And they're cycling some big comparable sales increases in the prior year period for their namesake Abercrombie brand. But the decline in comp sales, was down about 11%. Was way worse than what analysts were looking for. They were looking for a decline of, something like down 7%. The reason for that is they had some carryover inventory at lower average price points that they were selling through in the quarter, and that's what really took the comp sales down. But they were very optimistic about, third quarter start with their denim program, with their NFL collaboration. And so they feel like that's going to really benefit all of the initiatives that they have to benefit the Abercrombie brand going forward. So they feel like, no, this is just a little bit of a hiccup, nothing to be alarmed about. And I think what we're seeing generally when we think about all these earnings reports so far is that the consumer is resilient. We have the lower income being a little more strained and being very careful and choosing what they're going to buy, but when they see the value, they're spending.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Williams-Sonoma. I don't know. I don't shop there very often. Do you?
I used to more. I like their kitchen stuff, I have to say. I own quite a bit.
Okay. All right. The stock, they reported some numbers. Stock's off about 1% here today. Williams-Sonoma's sales surprises. Costs look manageable. That's the reaction from Bloomberg Intelligence. Let's talk to that analyst, Lindsay Dutch, Consumer Hardlines Senior Analyst for Bloomberg Intelligence. Lindsay, talk to us about Williams-Sonoma. What did you learn in their earnings release, and how's their business doing?
Hi, Paul. Thanks for having me. Williams-Sonoma had another really good quarter. We're seeing continued momentum in sales, which is a positive for them, especially given higher interest rates and new home sales being soft. And more importantly, they held the guidance for operating margin flat, even though they're facing tremendous cost headwinds from tariffs.
I'm looking at the stock right now. It's not doing much of anything, down about 0.5%. Why not a better reaction from Wall Street?
I'm also puzzled by that. I think that there's not much more that you can ask for from a company like this. They are working on getting to some sales growth goals. They're showing progress there. They are leveraging their scale, negotiating with suppliers. They're basically mitigating all of the costs from the tariffs that they're experiencing this year, which was basically a doubling in the tariff rate than they were expecting from the first quarter. So it's a significant headwind. They're basically planning to offset all of it with all of their mitigation efforts, and they're going to continue to see some profit growth this year. Long-term goals are intact.
So how are they mitigating it? So they're not going to pass anything along to consumers. How are they mitigating it?
So they are doing select price increases. Okay. They have multiple levers that they are pulling. So they are negotiating with their suppliers, sort of managing the cost sort of on the supply side. They're shifting sourcing, with the new threat of an additional tariff just on furniture imports. They're looking to increase U.S.-made inventory heading into next year. They are also increasing the prices. And the fact that demand is showing momentum, that's a positive sign that they can execute those price increases successfully and continue to get a good margin on those products.
So Williams-Sonoma is a company that also owns the Pottery Barn brand, West Elm, Curious if there was strength sort of across the board, across its brands.
Yes, so this was the second consecutive quarter that we saw same-store sales growth across all brands. Pottery Barn and West Elm are the two big ones that we've been watching over the past, say, 4 to 6 quarters. And that's because there really has been a bit of a challenge when it comes to demand for furniture. Coming into this year, we saw some positive momentum in that business. Williams-Sonoma has continued to outperform. So we saw growth in those two brands again in this second quarter, while the industry was still down for the quarter. So they are seeing, good demand with those two big brands, and they're saying that a lot of that is coming from the new products that they're launching.
See, I was under the impression prior to this furniture tariff talk that pretty much all our furniture came from like North Carolina, like Thomasville, North Carolina. That's kind of where I thought it all came from. That's not the case. Talk to us about furniture supply chains. Where does this stuff come from, and what is the tariff situation there on this stuff?
Right. So the best disclosure I have is from the end of last year, and I do think some of the numbers have moved a little bit. But at the end of fiscal 2024, Williams-Sonoma got about 18% of their cost of goods sold made in the U.S. They're a little bit higher than a peer like RH, which was closer to 10% at the end of last year. Part of that is because Williams-Sonoma has a lot more seasonal items and decor items rather than just plain furniture. I do think that number, probably is increasing throughout this year. And again, I think there will be an accelerated effort to get that number higher for 2026 with a threat of a new tariff. When we think about the other countries, exposure to China has drastically come down since 2018, 2019. That's more closer to the 20% range. But there's also exposure to Vietnam, which is a big one, and India, where the tariff just went up to 50%. So there's still more diversification to be done on the supply chain, and I think those efforts will continue heading into the next year. And
Lindsay, in about 30 seconds, connect these dots. How much are Williams-Sonoma's fortunes tied to the housing market?
So that's a great question. They will see stronger demand with a pickup in housing, but they've been lucky to see that higher income consumers still looking to update, within their kitchens in existing homes, and that is fueling demand over the past year or so.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Cracker Barrel cannot get enough of this story, Paul, apparently.
No.
So I want to bring in Michael Halen. He's Bloomberg Intelligence Senior Restaurant and Food Service Analyst. So has Cracker Barrel not been canceled now, Michael, because they're bringing back the old logo?
Well, I checked this morning, and some right-wing commentators are not happy about some of their past endorsements of the Nashville LG TBQ parade and some things like that. They have some issue with one of the board members whose experience is
enjoy the biscuits and gravy.
Is owning a DEI company. What's that?
Just enjoy the biscuits and gravy. That's where it stops and starts with me. It's awesome.
Yeah. Oh, man. It's crazy. I mean, Cracker Barrel now has been on both sides of the culture war, right? So, in the first Trump presidency, the left had taken issue with some people that were dining at Cracker Barrel, right? And now you have the right up in arms. It's kind of sad to see, to be honest with you. I think the right was on the right side of history the first time. And I think, now that they're in power, they're, the ones engaging in cancel culture. So it's kind of disappointing to see. I think they've been very unfair towards Julie Masino, who's, in our opinion, has done a great job so far.
One of the things more substantive than the logo is kind of the interiors of the restaurants and the menu. There's some big changes there with these new formats. Are they still moving ahead with that, Mike?
Yeah, and we're seeing results. They've been beating, and the street's been forced to raise their estimates throughout the year, right? So sales are inflecting higher. We expect traffic to inflect higher in this next fiscal year over the next 12 months or so. So, yeah, things are going well. I mean, they've gotten a lot of shade online about the remodels, obviously about this logo rebrand, but these people complaining clearly weren't going to the stores because same-store sales and traffic have been in the gutter for years. So, to us, I think a lot of the complaining is done by people that really don't frequent Cracker Barrel. They're using it as an excuse to kind of push their ideologies. And it is what it is. But
it's working.
These refreshes are working. They're bringing in, dinner business has improved for 5 straight quarters, right? And they're trying to bring in younger consumers who really basically left the brand for dead. It wasn't a member of their consideration set, right? And so we think the management team is making the right moves, refreshing their stores, giving them a fresh coat of paint, updating the furniture inside, right? And we expect these to continue to help boost results.
Yeah. Have they had to raise prices at all? Because I know that's a sensitive area for their customer base, really for everybody, right? But I mean, how have they been able to deal with tariffs and not having to raise prices unless they are?
Yeah, so they have a little bit more exposure to tariffs because of their retail stores in the front. About 20% of those items in that retail store are sourced from China. They have been working hard to source products from other countries or within the United States to try to ease that impact, right? But that's a smaller part of their sales. The restaurant sales are a much bigger part of their average unit volumes in the restaurants, right? The good thing for Cracker Barrel is that it's priced so far below its casual dining competitors, right? Average checks at dinner are, maybe 30-40% cheaper than some of their competitors, right? And so they've been able to lean into strategic pricing. They were late to the game there, and this new management team, this is one of their many initiatives that they've implemented to try to boost top line growth. And so they're strategically raising prices 5%, but it's at the units that can support it based on, demographics in the DMA.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Again, we've been reporting all day. J.M. Smucker's reported some numbers here. Some customers pulling back on some of their purchases here from some of these well-known consumer products that we all know and love in the supermarket. Diana Rosero-Pena joins us, Bloomberg Intelligence consumer analyst. Talk to us about J.W. Smucker's. What did you learn on their quarterly earnings?
Yes. So basically, they're trying to pass through cost increases from green coffee into their coffee portfolio. So far, it has paid off for them. They have experienced some growth and limited elasticity on that. Going forward, they're getting ready for a third wave of price increase at the end of this year. So that's probably going to test, pricing elasticity even further. But, there are some bright spots still for the company. You have Meow Mix. Cats seem to be doing well. You have Uncrustables, that part of their business is particularly strong. But then you have others such as Milk-Bone, which is not doing that well, and obviously Jif and the like.
The dogs don't like the Milk-Bone, I guess.
Well, it is a little bit of there's a discretionary pullback. It seems that even though the pet market has stabilized, there's the owners do not give as many treats to the dogs as they used to.
Well, even the dogs are feeling it. All right. What about their coffee business, though? Right? Because they own brands like well-known brands, Folgers, Bustelo, and these 50% coffee tariffs against Brazil. I mean, how is that impacting? How did it impact last quarter?
Yes, so they definitely added some pricing for that, and you can see coffee, like I said, it increased about 15% due to pricing. They expect tariff to be a 50-cent hit to EPS this year, which is an increase compared to 25 cents. That they said that it was last earnings call.
So, for the companies you follow, is there kind of a norm that you're seeing in terms of how much of tariff increases they want to pass along to consumers, how much they want to take in their margin and maybe how much they want to push back on their distributors? Is there any kind of norm?
So we're seeing, because all of these companies have moved pricing to the consumer at a higher level than they used to, they're starting to see some pullback in terms of volume not increasing to the way that they expected to. So they're trying to do other things. They're trying to do cost savings. For example, going back to Smucker, they're going to close the Hostess Indianapolis plant. So those kind of cost savings programs seem to be working. In terms of giving it to the retailers, their retailers are pushing back. I mean, you're talking about Walmart. They're definitely not going to be too pleased to increase prices even further.
Talking about Hostess, they bought Hostess not long ago, right, in 2023.
Correct.
But it's been a drag on the company overall.
Yes, and they're doing a lot of pullback. They're estimating they're going to take out about 25% of SKUs for that brand. They're really going in it in terms of they want to invest in the brand. They think that there's still room to grow. During the call, there was a lot of GLP-1 reference. If that was a little bit of a drag due to that, and they have mentioned that they don't see it as being that reason.
What are you seeing from the consumers? How is the consumer doing out there from the companies you follow? What are they saying?
Yeah, they're pretty much tired of the price increases. They're definitely trading down. You see Walmart mentioning that they're getting more higher income consumers. So that is definitely something that keeps these companies, the packaged food companies, on alert because there's so much room to grow and maneuver based off of all these things that are happening.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.